Hi and welcome back to Cheeky Crypto. My name is Nick and today guys we're going to be jumping down into the world of Bitcoin, taking a look at what's been going on most recently with the technical analysis, taking a look at some on-chain data and reviewing where I think things are heading. Now as I get into today's video, if you do find it useful and informative, smash that like button. I do appreciate that. If you are watching this on YouTube, then why not go ahead and subscribe, tap the bell, select all the notifications and you will not miss another video update. If you're watching this on X, why not do us a solid, give us a follow and a repost. Really do appreciate all of that. Let's go ahead and waste no more time. Let's jump right down into the desktop and take a look at what's going on here with the technical analysis on BTC. Kicking things off with the 1 hour time frame, we are still in our downward movement or trend, if you will. We are still tracking this fourth wave. It's still undecided whether or not we have started the fifth wave move to the downside or whether or not we are still in wave 4. Yesterday's developments are quite interesting. We saw another rejection from our 200 EMA on our hourly chart here, and we saw this rejection taking us down quite deeply. So it still looks like we are in this this bearish move. Still looks like the fifth wave is where we sit, as we have yet to break above 29,686. If we cannot break above that 29,986, then essentially we are going to be looking at moving down quite substantially. There are some recent developments though. We do see a change of character. This change of character takes us out of our bearish structures into a bullish structures. Just be aware though that these can sometimes be some fake outs. Okay, this is just algorithmic at the end of the day. And so when we take a look at a change of character like this, we need a break of structure to confirm it. Okay, we haven't got a bullish break of structure. We've only got a change of character. Okay, so our structures have changed their characteristics because this particular candle right here on 1700 hours yesterday, that's UTC +1 UK time, that one basically broke through this swing high here. That basically changed our characterization of our structure. Okay, that's essentially what that means. But without a break of structure, it doesn't have any confirmation to say that we're now bullish. With rejection here on the 200 EMA, I imagine that our break of structure would have only occurred if it broke higher than 26,986. So for now, we are still remaining in a bearish state of play. I actually jumped on a short position yesterday right up here, and I'll probably talk about that a little bit later this afternoon, or say in the video later. So let's go ahead and take a look at what else we can see here on our 1 hour time frame, where we can see that we have a fair value gap. The fair value gap is created from imbalances in the order books, and so this one here sits at 26,181 to the slightly higher range at 26,370 approximately. Okay, we haven't yet filled it out, which is why you can still see this green area just here. We have our discount range and we have a premium range at the top. So again, we're kind of just in between those at the moment. Ultimately though, with rejection from the 200 EMA, well, I guess the next stop is to see whether or not we can find support on that 50 EMA. Our momentum indicator is back down in the oversold area, so we might see a little bit of a move back up, maybe towards that 200 EMA. Again, we'll see whether or not we can break above that recent swing high. We are overbought on the 4 and 8 hour time frame, so that shows us we are looking for a move to the downside, which is why the short positions here are of interest to me, failing to kind of break that 200 EMA and basically failing to break the 26,986 area at the top there. So it's bearish, and so unfortunately we haven't got a break of structure. We haven't broken those things, so I am shorting the market here on BTC. The move to the downside still it remains the same. We're looking for 23,286 to 24,113. That hasn't changed. That's kind of where we're targeting out for that fifth wave move to the downside. Once complete, we'll have a more significant move upwards. So we can look at this a couple of different ways. The first is that we move down before we bounce up, and that would basically be looking like a liquidation event and so forth, or we would just break upwards and we're still in the wave 4. The only way to break the moves to the downside is to move up higher than 29,109. Okay, so that's the hourly chart. It's interesting. There's a few developments there, but it is, although we've got this kind of change of character to say that it's potentially turning bullish, I don't think that's the case. I think that's a fake signal. But you know, maybe I'm wrong. Let me know what your thoughts are in the comments below there. Let's take this up into the daily. Daily time frame, same as our hourly. We are tracking this impulsive move and this impulsive break to the downside. We are, of course, looking to essentially come down towards our low target, as we just spoke about in that fifth wave. That fifth wave move that we're talking about on the hourly chart makes up a wave 3 on our daily chart. Okay, so we can see here that would just be a wave 3, and then you can see that we'd have then a significant bounce up once we achieve that, hit 24,000 and then move up to 26, potentially even a little bit higher. Invalidation of this particular pattern comes right up here at 28,588, so we'd have to see a pretty significant bounce to kind of crash or I can get my words out, to invalidate this particular pattern to the downside, to prevent us from crashing to the downside like this. Now, at the moment on the daily chart here, we are below the 50 and 200 EMA. At the moment, the 50 EMA is still above the 200 EMA, which is basically an idea that we might be bullish, but with price action being below both, we can't be bullish at the moment. Ultimately, I do think we're going to see over the next week or so that 50 cross lower than our 200. I've got to bear in mind that these are lagging indicators. Okay, that's all they're doing is showing you previous price action, not predicting the future. And so as we know, we've already turned price down from the high of 31,000 down here, and we're waiting for that 50 EMA to reflect this. The same with the 200 EMA, right? So we're taking 200 candles into account for a 200 EMA, but we've got to take 50 candles into account for our 50 EMA. And so it's likely that the 50 EMA is going to cross below our 200 EMA before even thinking about another turn to the upside. This is only reflecting on what's already happened, not what's going to happen, but no doubt people will react to it. So we already know that the future here for BTC is quite bearish, because we have our structures that are mapping us down there under the psychology of traders and how they're behaving. And then we can see that in the future, probably over the next week, possibly two, that 50 EMA is going to cross lower than that 200 EMA, basically essentially meaning that we are likely to see even further downside at a later date as well, as people react to that negativity. So ultimately on the daily chart, not much has changed. We are targeting out 22,659 to 23,426 at some point in the future, but that's just based on standard movements after this pattern does complete. So that can change and will be subject to change as we get closer and closer to that. That's months out, in my opinion, not something that we'll see instantaneously. Which brings me up to a slightly different weekly view. I wanted to kind of talk about this one a little bit, because there's also a lot of hype, right? A lot of people kind of look at a few of these indicators and think that they're incredibly predictive of the future, when in reality, all they're doing is showing you what's already happened. These are algorithmic at the end of the day, and they are showing you outcomes based, they're showing you averages usually on previous price action, and people then look at the history and say, this happened, so we're going to do this again, essentially. Now, what they don't tend to do, or many analysts in the kind of social media kind of world, who I wouldn't say are actually analysts, they just kind of, jump on kind of like bandwagons, keywords, buzzwords, those kind of things, influence people without any of the real knowledge that sits in the background, unfortunately. Ultimately, when it comes to data, we take a look at some of these algorithmic based indicators, and we can't really be predictive of the future based on past history, not now for Bitcoin. There was a time when you could say, okay, well, if you do the same things, you're going to get the same result. And we haven't done the same things. And that's the part that people seem to be forgetting. Okay, there are differences between what's occurred most recently in price action versus what had occurred previously in price action. So that's really what this chart does. It kind of looks at the history of BTC and helps us understand where things are. And so just to kind of briefly summarize this, we can see that in 2013, we had a high. Okay, that was up here. I think it was $1,163. It was essentially 51,849% gains from the bear market low point. That was followed by an initial crash of 67% in 133 days. We bounced up, and then we went down into the bear market low. So it was a three-wave pattern, an A, B, C pattern, right? Or a WXY, depending on how you want to kind of articulate. I find ABC a little bit easier to explain to people. This move stayed right above and on 1.236 on the fib scale. Okay, so that retracement is exactly what you would expect of a three-wave pattern, right? It stays right within its parameters between 1 and 1.236. So that there is exactly perfect. You can see it was a perfect reversal. This is exactly where you would have been buying, and you would see that next bullish market. Then you go up into that 12,804% gains into 2017. And you see diminishing gains, of course, between 2013 and 2017 highs. Then we have that initial pullback. It was 69% in a 56-day period. We bounced up, and then we fell down into the bear market low point. The bear market low point stayed between 1 and 1.236, making it the perfect three-wave pattern. Okay, it's a three-wave pattern, WXY or A, B, and C, however you want to look at that. And ultimately here you can see it stays right within its parameters. So then you might be thinking, okay, cool. We go up into the next bull market. We see 2,068% gains in 2021. Again, diminishing gains. We can see that we started off with 51,000. We go to 12,000. We go to 2,000. I'll leave you to speculate where you think that next percentage gains are going to be. But here we can see that we had our high. We crashed down. Okay, that initial pullback was a 56% move in 70 days, I believe. And I'm just going to do some quick sense checks on that because it may be ever so slightly different. We are this one right here, 52%, 77 days. So that one actually reflects to a different one. So yeah, you can see 52% in 77 days. Okay, we then bounced upwards. Okay, we go up to 48K. And then we drop back down. Now, this particular move is not a three-wave pattern. Okay, we went down deeper than 1.236. In fact, we came down to the 1.382. Okay, so we know that from a fundamental analysis point of view, that's not candlestick driven, but Fibonacci sequence driven, we know that we have done something different. Okay, but that's only the first thing that we've done differently. Okay, so we're not a three-wave pattern. We are, because we've extended above and beyond 1.236, we are a five-wave pattern. This particular pattern is a W, X, Y, X, and Z, meaning that it was inevitable that we were going to have another move to the downside in November. And we were talking about this all the way through since June, July, August of 2022. We're saying that the bottom is not in. Okay, there are fundamental differences here. Okay, we're rewriting the history. You can't just look at the indicators and assume that history is repeating itself. So a new low is coming in. Z wave. Now, at this point in here, into 2023, I was still saying chances are we still have a high probability of moves to the downside into new bear market low points. Okay, we have moved and progressed higher than I had anticipated. I was looking for resistance around 25, 26K, which was the 250 EMAs on the weekly charts, as you can see. We did get rejected here, but we found good support at the previous area of the 1.236, right? 19,630. And so what we saw was actually a good reversal from that point. Now, I do not rule out the ideas that we can still go down into bear market lows, but for now, it looks like it's a high probability that the bottom is in, but a retest of around these existing lows, 19, 17K, looks like something that has to occur in the future as well. There's a CME gap at 20 to 21K, for example, fair value gap sat at 17K as well. So there's a lot of reasons to retest those existing lows outside of, again, just candlestick patterns and things like that. But nonetheless, I digress. Let's get back into what I'm talking about here and why I'm talking about all of these things, right? So we can see that we had Fibonacci differences between 2013, 2017, and of course the 2021 highs and all the corrections that kind of preceded those highs, right? We see that we went down fundamentally differently than we did, or at least we did in the previous two cycles. Then, of course, we have to acknowledge the other differences that have occurred here. One, we went down lower than the previous all-time high for the first time in Bitcoin's history, right? So in 2013, our high was $1,163. We went up into a new all-time high. When we had our bear market, we did not cross down lower than the previous peak, right? The previous 2013 peak. This time, though, we went up into 2021 highs. We came down lower than the 2017 peak. That's the first time in Bitcoin history that had occurred as well. And of course, this is testament to the fact that we have diminishing gains. Okay, so that's interesting. Now, Gaussian channel, that's the thing that's highlighted here with the green and the red, the kind of channel that you see going through here. These are glorified averages, essentially. But if you take a look at the Gaussian channel across the history, when you closed inside the Gaussian channel, you went into a bear market. And when you closed back inside it, you went into a bull market, right? And you can see this from the 2014 into 15 lows. Okay, you can see here we rode on the average highs. The second that we closed inside it, we went down into the bear market. We closed back inside, basically indicating that we were moving up. Once we closed above the Gaussian channel, we were good. We never came back into it. Okay, all the way up into 2017, you can see that we closed inside it for the first time, went down into the bear market low. We closed into the Gaussian channel, above the Gaussian channel, and we're done. The pandemic, however, back in 2020, closed us inside the Gaussian channel. We bounced out of it briefly and then came all the way back down underneath the Gaussian channel in March of 2020. I talk about these things because a lot of people are saying, well, once you close inside the Gaussian channel, you're done and you're in a bear market. And then once you're above it, you're in a bull market, right? And it's kind of been very predictive. It hasn't actually been that predictive. We can see that we had a blip up in here in 2021, right? December of 2021. We closed inside the Gaussian channel, and then the week after we closed above it. And that had never happened in the history of Bitcoin before. And it actually did lead us down into the bear market, which is fine, but it was basically a indication to say that actually, we can't just close inside straight away and then the week after close above it. And that's never happened in Bitcoin's history before. And what does that mean? And so therefore, we have put into question whether the Gaussian channel has predictive capabilities or not. In this particular case, it actually did move on down. But then, of course, we can acknowledge that we closed above the Gaussian channel, right, which is again supposed to be bullish. However, we've closed back inside the Gaussian channel. And so that's also something that we hadn't seen outside of the pandemic. Okay, so what's going to be interesting here is whether or not this is now going to be completely voiding the idea that the Gaussian channel is predictive based on the fact that this is something else that is now different than we had seen previously. We hadn't seen these things prior to the pandemic. And of course, we had a big black swan event to kind of create those kind of situations. Now we don't really have the same kind of level of black swan events, but the Gaussian channel is not behaving as it was looking at it in 2015 and 2018. It's acting vastly different now than it was previous. So again, this is testament to understanding that the fundamental foundations of the analysis on Bitcoin has shifted and changed. We're writing or rewriting Bitcoin's history now, which obviously is something that a lot of analysts on the social media platforms do not appreciate. They just look at the candlesticks and think, oh, look, we're doing the same thing. For example, what I'm tired of seeing on like X, for example, is where people will go ahead and grab bar patterns. Let me see if I can even find where it is in here, because I find it very frustrating. I can never actually find it for looking. I know it's in here somewhere. Let me see if I can find where it is hiding, which I can't. So it's obviously, I don't know where it is because I don't even use it. And I know it when I see it, but for the most part, I can't see it for looking, so I'm probably just going to be able to say no, it doesn't exist in my in my trading view. But essentially, what they'll do is they'll copy the ghost patterns from here, paste it over to this side, and say, "Look, we're going to the moon." And essentially, that's not reality of the situation at all. You can't look at these candlesticks and assume that they're going to repeat themselves when we have different foundational variables, right? We have the variables that sit in the background that are now vastly different than what they were previously. And that's kind of my point. So let's go ahead and bring up the on-chain data. Okay, so membership.𝗕𝗘𝗪crypto.io is our membership website. We have many different perks and benefits to the website. We have a 7-day free trial across all of those perks, so you can go ahead and test them out before you buy. Of course, if you do sign up with a free trial, make sure if you don't want to continue, you go to your profile and you cancel. Otherwise, you will be charged. We're going to be talking about the on-chain data, which is under the data zone for members, and we're going to go over to the Bitcoin on-chain data, and that loads up like this. So we have our overview. Okay, this basically shows you the all-time high, the number of days since this all-time high, the percentage that we're down, the amount of Bitcoin that was issued in the last 24 hours or mined, all the way through to the fees, the number of transactions, market cap, and all that kind of stuff. A few things worth pointing out. We have 19,466,156 BTC in circulating supply, out of the maximum 21 million. So we have to understand that the vast majority of BTC is out there in circulating supply. This is a really important thing to understand because a lot of people are going to tell you the Bitcoin halving is going to cause a bull run. It's going to halve the supply that's being mined. This is so bullish, so fantastic. You're going to the moon. We're going to see 100,000, 200,000, $1 million Bitcoin. Right. Okay. So what's left? 1.544 million Bitcoin to be mined. Okay, so 1.544. So why is that more important than the 19.4 million that's currently out in circulating supply? The reality of the situation is it's not more important. The price action comes down to just two very simple things: the supply and the demand. And at the moment, the majority of the supply is out there, meaning that Bitcoin halving event has very minimal impact. It has less impact now than it ever has done in the past because we've got 19.4 million in circulating supply. So really, if we want to see 100,000, 200,000, 1 million BTC, price action for BTC that is, then we're going to want to see the supply shrink. So reasons for people not to sell, or reasons to lock up the Bitcoin, or reasons for people to lose Bitcoin. You don't want people to lose Bitcoin, but you kind of get the idea. The supply needs to shrink. And then we need to see a reason for demand to come on in. Now, don't get me wrong. The Bitcoin halving is going to bring demand because it's a very easy concept for a lot of people to get. You're halving the supply that is going to be mined. But essentially, out of only 1.544 million that is left to be mined in Bitcoin's entire existence, really, the 19.4 is so much more important, right? Think about what's going to shrink the supply, not about what is going to prevent new Bitcoin from being issued, right? Yes, it's going to be good, but it's not going to be the big catalyst that people are telling you that it's going to be. Ultimately, it's going to create a lot of FOMO. It's going to create a lot of hype because it's a very easy concept to kind of communicate, to kind of get people all rallied up about it. But essentially taking a yearly issuance of 1.6 down to 0.8 really isn't that much of a big deal. More important to think about what's going to shrink the supply and what's going to increase the demand. So, you know, what outside of pure speculation is going to bring in the demand? Well, we already know that ETFs are going to be a huge driver for BTC, and it may coincide with a halving event, which will really just piss me off because it really just makes no sense that a halving event would generate such demand. Instead, the demand comes from the fact that there's a spot ETF or multiple spot ETFs, in fact. And so that's going to be the main driver for demand. What's going to shrink your supply? Well, people are probably going to know that there's a spot ETFs coming, and they're not going to want to sell. They're going to hodl it. And that's going to basically mean there's less Bitcoin available for purchasing on the exchanges. Therefore, supply-demand metrics become imbalanced and price rallies up accordingly. Okay, so very important that we understand that the majority of Bitcoins out there in circulating supply. Halving events are really insignificant now in comparison to where they were previously. It's not trick ourselves into thinking it's more than what it is. We are basically going to be taking a 1.6% yearly issuance or inflation rate down to approximately a 0.8 to 1% issuance. Okay, and so halving the mining supply is going to be interesting, but there's also some concerns that we have around this if Bitcoin cannot create a huge imbalance in that supply demand, because it has to be profitable for miners. If it's not profitable for mining operations, then unfortunately you're going to find a very centralized Bitcoin at some point in the future. And I suspect that that is probably where things will end up going in the future, specifically at the cost of energy these days, unless you get a good source of energy that makes this more manageable, more affordable for those miners. In 50 years' time from now, it's hard to think that Bitcoin will be a decentralized network. You can let me know your thoughts on that one in the comments below, which I imagine I'm going to get a lot of hate for all of this, but it is what it is. My opinion nonetheless. When we take a look at wallet counts, the number of wallets that have a specific number of Bitcoin in them, we can see that retail investors continue to buy up the dips as they believe these ETFs and everything else are coming real soon and we're going to the moon, we're in a bull market. The reality of the situation is we are probably not going to see a spot ETFs until Q2 2024. And that's quite a long time for retail investors to hold. I suspect that we're going to see selling pressure towards Q4 2023, and retail investors may succumb to some selling pressure. At the moment, we have over 1 million wallets that have over 1 Bitcoin in them, and I suspect we need to see at least a 30% drop in this in order to allow the larger institutional investors to purchase Bitcoin, right? We want to see, we want retail investors to hold out, obviously. But I suspect that if we want to see institutional investors come on in here, then they need to be buying Bitcoin, and they're going to have to buy it from somewhere, right? As I say, there's only 19.4 million Bitcoin out there, and therefore it has to be sold from someone to these institutional investors. So it's all great that we talk about, BlackRock coming in here, but where BlackRock buying their Bitcoin from? Are they buying it from other institutional investors? Possibly. Are they even buying right now? Probably not at these prices. I suspect that they're going to be looking to buy from the retail investors at some point in the future, and a 30% drop in wallets that have over 1 Bitcoin could be interesting. I did go through this the other day. A large amount of that 19 million BTC sits with retail investors, and I find that quite a scary thought in itself, because retail investors usually overreact to price action and usually are more emotional when it comes to their investments than the institutional side of the coin. So some interesting stuff nonetheless. Now, when we kind of bring this up into our exchanges, not that one, this one, we can see liquidations in the last 24 hours of $33.6 million. We have Binance at the top of the list with $10.65 million of liquidations. 26.9% were long positions that were liquidated, and shorts were 73.1%. Binance were 31.67% of all liquidations. OKX was 31%. Huobi was 19%. Bybit 9.9%. What do I find odd? I find odd that Huobi was 19.04% of liquidations ahead of Bybit. Again, they've actually been quite heavy on the liquidation side when it comes to Bitcoin for quite some time now. The other one that's kind of jumping out to me is CoinEx. It's kind of climbing up those rankings quite a little bit. They've had $305,000 of long positions that were liquidated and 1.3 million in short positions, a total of 1.6 million liquidations on CoinEx. Now, I do find that quite unusual. Normally they are not as high on the rankings, but it is what it is, and we'll keep a close eye on some of these exchanges. So yeah, it is kind of what it is. Now, when I talk about exchanges, I think it's important that we spread our own risks as retail investors. We don't keep our cryptocurrency on exchanges. Instead, we use hardware wallets like Ledger Device. And no, don't worry, that FUD around the private keys is literally just that. It's fear, uncertainty, and doubt. None of it is actually factual. Understand what it is you hold. It's hardware. It's not software. It's not anything more than that. There's no backdoor. And you have, of course, as the user of that hardware, have to sign those transactions and agree to send your private keys if you wanted to use Ledger Recover. I'm tired of talking about it, but if you don't understand it, you can join us down in Discord and we can kind of talk you through the mechanics of all of that. Nonetheless, I use Ledger. I do not keep crypto on the exchanges. There are, of course, a few exceptions to this. Sometimes you need to place some limited orders. I try not to. I try to do market orders where I possibly can, but I do have the luxury of sitting at a desk, sitting at the computer here and monitoring these things. So meaning that I can actually do market orders as we see price pulling right the way back down, for example. Occasionally I have to do limit orders, which is probably why most people tend to keep stablecoins on exchanges, because they have their limited orders there. And of course, they're just waiting for these prices to come on in. So I get it. At the same time, we want to spread that risk. Make sure we're registered to as many different exchanges as we possibly can, and we don't just hold all of it in one centralized place. This allows you to say that, okay, well, if one exchange goes down, you maybe lose 5-10% of what you're holding rather than 100% of it. Okay, this is something that FTX taught us incredibly well in previous years, right? We saw FTX in 2022 collapse, and we did catch wind of that much earlier because of this data here, right? This data led us into seeing that they were liquidating way too many positions, and we told people you might want to get off of FTX and protect yourselves, short FTT, short Solana, etc., because this looks like it's going to end badly. We were correct. It did end badly. Unfortunately, most of the cheeky crypto community were perfectly safe in that because we have our eyes on the data. Now, obviously, when it comes to spreading that risk, use proper risk management, all those kind of things. We have risk management course on our website, so you can again access that through membership.cheekycrypto.io. Now, when it comes to spreading that risk and using multiple different exchanges, I think that's the best strategy to have. Sign up to as many different exchanges as you possibly can, and that will set yourself up for success in the future. Now, BitGet is my go-to platform at the moment. I use it for 100% of my leverage positions and 90 to 95% of my spot positions. Okay, and if you do use the affiliate link in the description down below, you're eligible for up to $8,000 of rewards, depending on how much you deposit and trade on the platform. And, I think, if you did sign up to BitGet, you wouldn't regret it. It's a really nice to use and easy to use platform. And I said it quickly became my go-to, but by no stretch of the imagination is it my only platform that I use. There's other links in the description below and in our Discord server. We have accounts in many different places for good reasons, spreading the risk. I have accounts with Binance, Coinbase, KuCoin, Gate.io, Bybit, Crypto.com, BitGet, and so many others, right? It's important that you have access to as many of these exchanges as you can, spread that risk, and make sure that you set yourself up for success in the future. Which brings me on to the trade side of today's video. We've seen our members do some really good trades recently. So we can see that JB was shorting and going long on Matic. We've got 𝗖𝗢𝗠𝗠𝗘𝗥𝗦, TRU, Matic, and then of course Reggie Classic's been a very bit busy last week. Not had much time on the charts, but lots of trades coming in, and lost a few over the weekend. Yeah, like we don't tend to target out the small volatility, but it seems that Reggie has made some pretty decent gains in the community as well. So ultimately, many different trading opportunities that do sit out there. So why not go ahead and jump into the Discord? The Discord itself is completely free. If you want to become a member, there's a 7-day free trial. But obviously, if you don't want to continue, make sure you do cancel that through the website on your profile section. Guys, I think I'm going to wrap this video up right there. If you have found this useful and informative, smash that like button. I do appreciate that. If you are new to the channel, then why not go ahead and subscribe, tap the bell, select all the notifications, and in doing so, you will be kept up to date with everything that we do here at Cheeky Crypto. Until the next one though, guys, have a fantastic day.